Building enough dividend income to meaningfully impact your finances can seem intimidating at first, especially when the goal is to create cash flow that arrives whether you're working or not. But like most wealth-building strategies, it starts with small, consistent steps rather than huge amounts of money. The key is understanding how dividend-paying investments work, how compounding accelerates growth over time, and how reinvesting income can gradually turn a modest portfolio into a larger cash flow-producing asset. Today we will talk about how I'm building $500 a month in dividend income step by step. So before we get started, make sure to hit that like button, also subscribe to my channel. 10. Most people think dividend income is only for the rich. When people hear about dividend income, they often imagine retirees with million-dollar portfolios collecting checks while relaxing on a beach. Because of this, many assume dividend investing is only useful once you already have significant wealth. That belief keeps a lot of people from ever getting started. The reality is very different. Every large dividend portfolio starts as a small one. Nobody begins with thousands of dollars arriving every month in passive income. The process usually starts with a few shares, a small investment account, and a long-term commitment to consistency. 9. Understanding what dividend income actually is. Before building dividend income, it is important to understand what dividends are. Certain companies distribute part of their profits directly to shareholders. Instead of keeping all earnings internally, they pay investors a portion regularly. These payments may arrive quarterly, monthly, or annually, depending on the company or fund. When investors own shares, they become eligible to receive a portion of these distributions. The attractive part is that dividend income can continue arriving regardless of whether shares are sold. Unlike relying entirely on capital appreciation, dividends create ongoing cash flow while the underlying investment may still continue growing in value over time. This combination of ownership and income is one reason dividend investing remains popular among long-term investors. 8. The first step was creating an investing habit. The biggest challenge was not choosing stocks, it was creating consistency. Many people spend months researching investments while never actually investing. I realized early that the habit mattered more than the perfect portfolio. Instead of waiting until I had large amounts of money available, I focused on contributing regularly. Whether markets were rising or falling, the goal remained the same: continue adding money consistently. This removed emotional decision-making from the process. Rather than trying to predict markets, I concentrated on building the portfolio month after month. Over time, consistency became more important than timing. 7. Reinvesting dividends accelerates growth dramatically. One of the most powerful parts of dividend investing is reinvestment. Instead of spending dividend payments immediately, I reinvested them back into additional shares. This creates a compounding cycle, where dividends buy more investments, which generate more dividends, which buy even more investments. At first, the growth feels small. The numbers seem insignificant. But eventually the portfolio begins generating larger distributions simply because more shares are producing income. This is where compounding becomes visible. The portfolio starts helping itself grow. Many investors underestimate how powerful dividend reinvestment becomes over a decade or longer. 6. Focusing on quality over yield changed everything. One mistake many beginners make is chasing the highest dividend yield possible. At first, high yields seem attractive because they promise larger immediate income, but extremely high yields can sometimes signal financial problems within a company. Instead, I focused more on quality businesses with strong histories of profitability, stability, and dividend growth. A slightly lower yield from a stronger company often produces better long-term results than chasing the highest payout available. The goal is not simply maximizing income today, it is building a reliable stream of income capable of growing for years. 5. Dividend ETFs simplified the process. Another major improvement came from using dividend-focused ETFs. Instead of selecting every stock individually, dividend ETFs allow investors to own baskets of companies through a single investment. This provides diversification automatically while still generating dividend income. For someone building income steadily over time, ETFs reduce risk and simplify management significantly. Rather than worrying about individual companies constantly, the focus shifts toward consistent investing and long-term growth. This simplicity made the entire process much easier to maintain. 4. Small contributions matter more than most people realize. One of the biggest misconceptions about investing is that large amounts of money are required to make meaningful progress. In reality, small contributions repeated consistently can create surprisingly large outcomes over long periods. Even modest monthly investments add up when combined with market growth, dividend payments, and reinvestment. Many people delay investing because they think their contributions are too small to matter. The truth is that time often matters more than starting size. A portfolio built gradually over years frequently outperforms a larger portfolio started much later. 3. Dividend growth is more powerful than static income. Something many people overlook is that dividend income itself can grow. Certain companies increase their dividend payments over time as profits expand. This means investors may receive larger payouts without purchasing additional shares. When dividend increases combine with reinvestment, income growth accelerates significantly. The result is that the portfolio does not simply generate cash flow, it gradually generates increasing cash flow. This growing income stream is one reason dividend investing appeals to people focused on long-term financial independence. 2. Reaching $500 per month is really about building assets. The $500 monthly goal sounds like an income target, but it is actually an asset-building goal. Dividend income is simply a reflection of ownership. The more productive assets accumulated, the more income those assets can generate. This mindset shift changed how I viewed investing. Instead of focusing only on monthly payouts, I started focusing on acquiring more assets capable of producing future cash flow. The income became a byproduct of ownership rather than the sole objective. That perspective made the entire process feel more sustainable. 1. The real secret: the first $500 per month starts long before you reach it. The deeper truth about building dividend income is that the hardest part is not collecting the income, it is developing the habits required to reach it. Because the truth is simple. $500 per month in dividends is usually built through consistent investing, reinvestment, patience, and ownership accumulated over years rather than through one big investment decision. Most people focus on the destination while ignoring the process. But the process is what creates the outcome. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.